Welcome to the Deep Dive. Today we're really getting into a topic that, well, it hits every Canadian's wallet. Personal income tax. We've sifted through your sources, aiming to cut through all the jargon. The goal here is clarity, some key strategic takeaways, and maybe even a few surprising bits of info. Our mission: to turn what can feel like a really overwhelming subject into something you can grasp quickly but thoroughly, all tailored for you.
It's so true. And understanding personal income tax is, well, it's fundamental, isn't it? This is what funds our healthcare, our schools, all those vital services. And for you listening, it's not just about, ticking a box and meeting obligations. It's really about making sure you claim everything you're actually entitled to: benefits, credits, the lot. And what often gets missed, I think, is that dual system Canada has. You've got the federal tax and the provincial or territorial tax. It affects everyone slightly differently.
Okay, let's unpack this then. To really get a handle on your taxes, we probably need to start with the absolute basics, some core definitions. Most people kind of get what income tax is, right? It's the tax on money you earn from your job, investments if you live and work here. But that tax return form you fill out every year, what is it actually, beyond just paperwork?
Yeah, good question. So think of your tax return as your yearly financial snapshot. It's a report you have to send to the Canada Revenue Agency, the CRA. It details all your income for the calendar year, so January to December, and its main purpose: to square things up. Did you pay enough tax, too much, or do you owe a bit more? And what's really fascinating, I find, is that even if you had zero income, like absolutely nothing, you're often still advised to file.
Oh, right. Why is that?
Because it's the key. It's the gateway to getting benefits and credits you might be eligible for. Things like the GST, HST credit you'd completely miss out otherwise.
Ah, okay, that makes sense. So who actually has to file then? Is it everyone?
Well, generally, your need to file comes down to your residency status. And the CRA figures that out by looking at your residential ties.
Residential ties. I know it.
Things like, do you have a home here? A spouse or common law partner? Dependents living in Canada, that sort of thing. And it's really important to remember this is separate from your immigration status.
Okay.
So for instance, if you're an international student and you've been living in Canada for, say, 183 days or more in a calendar year, you're usually considered a resident for tax purposes. Doesn't matter what your visa says.
Got it. And you mentioned that layering of federal and provincial taxes. That sounds like it could get complicated. Does it mean filing twice, or is it simpler?
For most people, thankfully, it's simpler. If you live anywhere except Quebec, you file just one single tax return with the CRA, and that covers both federal and your provincial or territorial taxes.
Oh.
Quebec residents, though, they're the exception. They have to file a separate provincial return directly with Revenue Quebec. But for everyone, the provinces and territories set their own tax rates and brackets, and those get applied on top of the federal ones. So your total tax is, a combo of both.
Right. Okay, let's talk numbers then. Because understanding how those federal tax brackets really work seems pretty fundamental. Where does the money actually go? For 2025, what are we looking at?
Okay. Federal rates for 2025 are 15% on the first $57,375 of taxable income.
Okay.
Then it jumps to 20.5% for the income slice between $57,375 and $114,750. Then 26% on income from $114,750 up to $177,882. After that, it's 29% between $177,882% and 2x $53,404. And finally, anything you earn over 253% on everything if you earn over that amount. Exactly. That's the critical insight. It's a progressive system. You pay higher rates only on the portion of your income that falls within each specific bracket. So yeah, that 33% rate only applies to the dollars above $253,414, not your whole income. And even before any of those rates kick in, there's the basic personal amount, the BPA. For 2025, it's $16,129.
Right.
That amount gets subtracted from your total income first to find your taxable income. You can think of it like a tax-free zone. Everyone gets to earn that much before federal tax applies at all.
That really clarifies the federal side. But then how do the provincial rates layer on top without making it, impossible to calculate?
Well, the good news is for most people, the CRA does the calculation for you on that single return. The provincial rates layer right on top using their own brackets. So for example, Alberta's bringing in a new 8% bracket. It applies to the first $60,000 of income starting January 1st, 2025.
Interesting.
Yeah, and for someone earning at least that much, it could save them up to $750. So you see how provincial changes directly hit your bottom line.
Definitely. Okay, so understanding what gets taxed is one thing. But knowing when you need to act is just as crucial. Let's get those key dates for the 2024 tax year sorted. When can people actually start filing?
You can start filing online pretty early, actually. CRA-approved software usually opens up around February 24th, 2025.
Okay, good to know. And T4s, when should we expect those?
Employers have until February 28th, 2025 to get those T4 slips out to you. So keep an eye on the mailbox or your online portals around then.
Right. And for RRSP contributions for the 2024 year?
The deadline for that is March 3rd, 2025. That's if you're 70 or younger, of course.
Got it. And the big one, the main filing deadline.
For most people, it's April 30th, 2025. That's the deadline to both file your return and pay any tax you might owe.
Okay.
And if April 30th lands on a weekend or holiday, it bumps to the next business day, which is handy.
What about self-employed folks? I know they sometimes get a bit longer.
They do. Self-employed individuals and their spouses or common law partners have until June 16th, 2025 to actually file their return. That's pushed back from June 15th because it's a Sunday.
But, and this is a big but.
Huge but. Any tax they owe is still due by the earlier April 30th deadline. Doesn't matter when they file. That catches a lot of people out.
Yeah, definitely one to flag. Okay, so deadlines covered. What about how people file? What are the main ways?
Online filing is definitely the most popular, way faster, generally more efficient.
Right.
You can use the CRA's NETFILE system yourself with software like Wealth Simple Tax, or get a tax preparer or accountant to use EFILE for you. And really, online filing helps the whole system run smoother. Quicker processing, faster refunds. It all connects.
Makes sense. Any other ways?
Yep, you can still mail in a paper return. The CRA looks at the postmark date as your filing date, and there's some special methods too. The CRA sometimes invites eligible low-income Canadians to file using an automated phone system, or even speak to an agent to file. But that's by invitation only, usually.
Okay, so when you're deciding on your approach, thinking about whether to use software or maybe hire someone, what are the real upsides of getting professional help? Is it worth the cost?
It can be, absolutely. A tax professional, they know the rules inside out. They can help you avoid calculation errors, sure. But more importantly, they can spot deductions or credits you might have totally missed. Plus, there's the peace of mind. Many offer liability insurance if there's an error. They're not just number crunchers. They can offer strategic advice for your specific situation.
Right. Moving beyond just compliance to actual planning. Okay. Makes sense. Yeah. So we've got the basics, the deadlines, the filing methods. The next big thing is maximizing your return, right? Using those deductions and credits effectively. Let's start with the toolkit. What documents do people absolutely need together?
Okay, essentials first. You'll need your income statements.
Yeah.
T4s are the main one. T4As if you got scholarships, bursaries, tuition waivers, that kind of thing.
Okay.
Grab last year's notice of assessment from the CRA. That's super useful. Receipts for any RRSP contributions you made. Tuition payment receipts, look for a T2202 form. And statements if you paid interest on student loans.
Any province-specific stuff to watch for?
Yeah, definitely. Depending where you live, you might need proof of rent or property tax paid, like in Ontario or Manitoba, or maybe records of home energy costs in Ontario. Worth checking your provincial rules.
Okay, quite a list to pull together. And once you have all that, people often mix up deductions and credits. What's the actual difference, and why should you care?
Yeah, it's a really common mix-up, but getting it straight is key for your tax strategy. So deductions, they reduce your total income before you calculate the tax.
Right, so they lower the base amount.
Exactly. They lower your taxable income. And the cool thing is, this might even bump you down into a lower tax bracket. Think RSP contributions, that's a classic deduction.
And credits?
Credits work differently. They directly reduce the amount of tax you actually owe, dollar for dollar, often.
Ah, okay. So a $1,000 credit saves you $1,000 in tax, but a $1,000 deduction saves you, well, whatever your tax rate is on that $1,000.
Precisely. That's the crucial difference. Credits directly lower the final tax bill.
Got it. So knowing that, what are some common deductions and credits people should be aware of, things that can really make a difference?
Well, there are quite a few common ones. Medical expenses above a certain threshold. Charitable donations, always keep those receipts. Child care expenses can be a big one.
What about working from home?
Right, home office expenses. Now, for employees, the simplified flat rate method is gone for 2023 taxes onwards, so you'll need your employer to fill out a T2200 form to claim actual expenses.
Okay, good clarification. Anything else?
Moving expenses, potentially.
Yeah.
If you moved at least 40 kilometers closer to a new job or to go to school full-time, though there are specific rules if your income was from tax-free scholarships. Also, union or professional dues you paid, and even digital news subscriptions. There's a small credit for that now.
And other credits.
Yeah, some really valuable ones like the Canada Workers Benefit for lower income workers, the Canada Caregiver Credit if you support someone with an impairment, and the first-time home buyer's tax credit. Definitely worth looking into those if they might apply to you.
Wow. Okay. Lots of potential ways to reduce tax. You mentioned keeping records earlier. I guess this really drives home why that's so important year-round, not just in like March or April.
Absolutely critical. I think the biggest mistake people make is just not being organized throughout the year.
Yeah, I could see that.
You forget expenses, things you genuinely paid for that could have been deducted or claimed as a credit, so you end up paying more tax than you need to. Just knowing what might apply to you and keeping those receipts or documents filed away somewhere safe, it makes a huge difference. Less tax, less stress if the CRA asks questions later.
For sure. Okay, let's switch gears a bit. Talk about some special situations and also what the CRA seems to be focusing on these days. What about newcomers to Canada?
Right. If you're new, you might have to file a return even if you were only here for part of the year. It depends on establishing residency. And there's something crucial, often missed, for newcomers or anyone with assets outside Canada. It's Form T11-135.
T11-135, what's that?
It's the Foreign Income Verification Statement. You have to file this if you owned foreign investment property, things like stocks, bonds, rental properties outside Canada, where the total cost was over CAD $100,000 at any point in the year.
Okay, $100,000 threshold. Good to know.
And keep records of the fair market value of any property you owned before you immigrated. That's important for later tax calculations if you sell. And failing to file that T1135 or not reporting everything on it, that's not just a slap on the wrist. It automatically extends the CRA's time limit to reassess all your taxes by an extra 3 years. Turns a simple mistake into a big potential headache.
Wow, okay. Definitely don't want to miss that one. And when the CRA does decide to look closer or conduct an audit, are there particular areas or types of taxpayers they tend to focus on?
They do have priorities. Generally, the CRA tends to focus audits more on non-salaried employees, like self-employed individuals or those earning commissions. Their income streams can be, let's say, less straightforward than a T4.
Makes sense.
Self-employed folks can get picked randomly, but the CRA also looks at the type of business and the kinds of expenses being claimed. Other triggers, big discrepancies between income reported and lifestyle, issues around whether something is regular income or a capital gain that's huge for investments in real estate sales. Making very large charitable donations can sometimes attract attention. Using trusts, especially complex ones set up in provinces with lower tax rates. They also look closely at sophisticated strategies, like trying to convert dividends or regular income into lower taxed capital gains, or certain ways of passing businesses between generations. Taxable employee benefits are another one, like, are you properly reporting the personal use of a company car? And real estate is a huge focus area, especially in hot markets like Vancouver and Toronto. They're looking hard at property flipping, assignment sales before construction finishes, unreported rental income from platforms like Airbnb, unreported GST/HST on sales, unreported capital gains, and making sure residents report their worldwide income, not just Canadian.
Seems like they're really cracking down on avoidance and evasion, especially with complex or international stuff. What steps have they taken recently?
They've definitely ramped things up. The CRA is doing more examinations of high-risk, wealthy taxpayers each year. They even have a special program just to target organizations that promote dodgy tax schemes for the wealthy. Financial institutions now have to report all international electronic money transfers of $10,000 or more. There's the offshore tax informant program, basically, a whistleblower line where people can get rewarded for tips that lead to collecting significant unpaid taxes. And in 2023, the rules got tougher around disclosing aggressive tax planning. Certain types of transactions, called reportable transactions and notifiable transactions, now have mandatory disclosure requirements with big penalties if you don't comply.
Wow.
Oh, and one more big one. Since January 22nd, 2024, there's a publicly accessible registry showing the beneficial owners, the real people behind the scenes of federally incorporated private companies. More transparency.
Lots of changes aimed at transparency and compliance. What if someone realizes they haven't been compliant in the past? Is there any way to come clean without facing the harshest penalties?
Yes, there is. It's called the Voluntary Disclosures Program, or VDP. It's basically a way to approach the CRA and correct mistakes or omissions in your past filings. If your application meets the conditions, like it has to be truly voluntary before the CRA contacts you, complete, involve a potential penalty, be for information at least a year overdue, and you have to pay the estimated tax owing for, then you might get penalty relief and sometimes interest relief too. It's a chance to fix things proactively.
Good to know that option exists. Okay, so let's say you've done everything right, you've gathered your documents, filed your return, you hit submit. What happens next? How long does it usually take?
If you filed electronically, it's usually pretty quick, often as little as 8 business days to process. Paper returns, though, take much longer. Think more like 8 weeks.
Okay, and then
You'll get your notice of assessment, or NOA, that's the official document from the CRA saying they've received and reviewed your return. It shows their calculations, whether you have a refund or owe money, and importantly, your RRSP contribution limit for the next year. Keep that document safe.
All right, the NOA is key. What if, after you file, you realize you made a mistake, left something out, put in a wrong number?
Don't panic. First step is to wait until you actually receive that notice of assessment. Don't try to fix it before then.
Okay.
Once you have the NOA, the fastest way to make a change is online, using the Change My Return function in your CRA My account. Corrections made that way usually process in about 2 weeks.
And if you can't do it online?
You can send in a paper form, T180J, but again, that will take longer to process, probably around 8 weeks or so.
Good to know. And refunds. You mentioned direct deposit earlier.
Yes, the government is really pushing for direct deposit. They've pretty much phased out sending checks for most payments, including tax refunds.
So how do you set that up?
Best ways are through your CRA My account online or often directly through your bank or financial institution's website. One change, though. Starting March 24, 2025, you won't be able to set up or change direct deposit info through tax software using EFILE or by calling the CRA. You'll have to use My account or your bank.
Okay, important logistical point there. Finally, and this is so crucial these days, CRA scams. They seem to be everywhere and getting more sophisticated. How can people protect themselves? What are the red flags?
This is huge. Protecting yourself is paramount. The real CRA will never do certain things. They will never demand immediate payment using weird methods like e-transfer, Bitcoin, or other cryptocurrencies, or gift cards. That's a massive red flag.
Right. No gift cards for taxes.
Exactly. They will also never threaten you with immediate arrest or deportation. They won't use aggressive, threatening language. They won't ask for personal info like your SIN or bank details via email or text message. They won't charge you a fee just to talk to someone on the phone. And they definitely won't agree to meet you somewhere public, like a coffee shop, to collect a payment.
Okay, those are very clear warnings. So what's the bottom line advice? If someone gets a call or email that feels off?
The single most important piece of advice is, if you have any doubt at all, hang up or delete the message. Then, you initiate contact with the CRA yourself using their official, publicly listed phone numbers or website. Never trust contact info given in a suspicious message. Verify independently.
Absolutely. Always go directly to the source through official channels. If you get a suspicious call or email, contact the CRA to check if it's legit. And if you think you've been targeted or fallen victim, report it. Well, that brings us towards the end of this deep dive. Hopefully, this has given you a much clearer, more strategic view of Canadian personal income tax. We aim to cut through that complexity and pull out the insights that really matter for you.
Yeah, and while tax planning can get complicated, just understanding these fundamentals really does empower you as an individual. Thinking about this stuff proactively during the year, keeping good records, it can honestly change your whole tax season experience, make it less of a mad dash and more of a, well, manageable process.
So what does this all mean for you listening right now? We hope you'll take a moment to think about your own financial habits. How might these insights change how you approach tax season next year? Maybe turn it from just a chore into, well, an opportunity to be more strategic. And here's a final thought for you to maybe mull over. We know the tax system funds public services. That's its main job. But think about how it also uses deductions and credits to actively encourage certain things, saving for retirement, donating to charity, buying a first home, investing in education. How could understanding those built-in incentives maybe help you align your own financial decisions, not just with your personal goals, but maybe also with the broader economic aims the country is trying to promote? Something to think about.